Welcome to another edition of Financial Forensics. I think this will be the last session, our last two sessions, last but one session of financial accounting, and then we will move to core finance. So, we are moving away from accounting to we will move to finance. And today what we will be doing, or this session what we will be doing, and possibly the next session also, will be somewhere the transition between accounting to finance. Now, why do I say transition? What did we learn as far as accounting was concerned? As far as accounting was concerned, we learned basically to work on three basic financial statements. That is, we learned balance sheet, we learned income and expenditure account, income and expenditure statement, third, we also learned what to do with cash flow statement. Now, what do these give? These statements give you the situation or the current facts out there. That is, when I say facts, why did I use the word fact out there? Balance sheet gives you what is the asset and what is the liability you own as on a day, or income and expenditure statement gives you a list of transactions out there. Now, by looking at it as, of course, I know what is the cash, I know what is the profit, and etc., etc., etc. out there. But I need to analyze these financial statements. That is where the beginning of what you call is a transition from accounting to finance starts out. Now, I analyze out this. What we are going to talk about today, or in this session or the next session, is going to be somewhere in between. You can attach it with accounting, you can attach it with finance, and it's somewhere in between both. So, what do? We analyze the financial statement. Now, why do you need to analyze? We need to analyze to look at what is called as the overall performance of the enterprise. Number one. Number two, imagine you are a credit provider, you are a loan provider to the company out there, you are a loan provider. You want to know the performance of the company, not the overall performance of the company. That is, of course, out of your interest, but your primary concern is what? Will you get back your money? How long will it take for you to get back your money? Is the company servicing, or will the company be able to pay interest on the loan what they have taken from you, etc., etc., etc. Imagine you are a supplier of raw materials on credit to the company. If you are a supplier of raw materials on credit to the company, what are you interested in? You are interested in two things. One, will you get the money? Of course, yes. Number two, when will you get the money? You might get the money after a year, but you are given a 30-day credit to him and he will pay after 1 year. That means what? You have lost interest for about 11 months on that money that is blocked out there. So, what do you need to know? You need to know when will you get the money, as well as will you get the money out. So, each stakeholder, that is what we say, will have a different concern as far as the entity is concerned. So, what do? We take these three financial statements and then we analyze these three financial statements, and then the finance part starts from there. So, we analyze to look at what is called as the profitability, the performance, the utilization of the assets. For example, I will say one more aspect. Imagine I have what is called as assets or fixed assets worth about 100 crores. My turnover is only about 10 crores or 20 crores. So, can I look at utilization? I am not utilizing all the assets I have created out there. So, I want to know whether the revenues are sufficient enough to let me know whether the assets are being utilized in the process out there. Now, I can also look at what is the kind of liquidity. I might have fantastic profit I might have fantastic revenues out there, but I will not have liquid cash to pay off all my current liabilities or my creditors, the people who have supplied goods to me on credit. I will not have money to pay them because I will have a liquidity problem. So, all those aspects is what we analyze and then we look at. How do we do this analysis? We do this analysis with the help of what do we call it as couple of, I am going to use a different color, with the help of ratios. We do this analysis with the help of couple of ratios. There are a set of ratios. Now, what are the set of ratios? Do not worry, I have already what do you call it as uploaded the set of ratios out there. I have got a set of ratios. Are these the only set of ratios? No, these are only indicative set of ratios. I am going to explain each of these, do not worry about it. I am going to explain each of these ratios out there. Each of these 25 ratios, again, where did I pick up? I have picked up from only the prescribed textbook. That is where it says discussed in chapter. In the chapter of the textbook, I have picked it up only from the textbook of Anthony and Hawkins, and prescribed textbook for this course. One of the prescribed textbook, I have picked it up only from there. That is why I said discussed in chapter out there. Right? I am going to discuss each of these ratios out. Now, are there 25 ratios or something you have prepared? Sir, is there only 25 ratios? No, your ratios will also depend on the kind of situation or the kind of analysis that you are trying to do out. Some ratios may be irrelevant in some situations. Some ratios you may have to devise depending on the situation. These are only indicative. Now, what are the situations? Let us take a couple of things. Let me take a couple of aspects out there. I am not going to go in the same order of these 25, but I am going to look at what is called as a couple of what do you call it as a little slightly. I am not going to take it exactly in the same order, but we will try and cover overall all these ratios. So, as a first step, what do? We look at, as a first step, we say ratios. Now, let us look at it from one aspect out here. One by one, let us take. I am not going to take it in the same order as I said. I am going to take it in a as a discussion. So, we will try and cover all this. Imagine you are a capital provider out there. Imagine you are a capital provider. And in that capital, you are a debt provider. So, what are you interested in? I am interested in knowing whether there are two things I am interested in knowing. What is the composition of the capital? When I say composition of the capital, that is, I want to know what is the percentage of equity in the company, what is the percentage of debt in the company. Now, why do I need to know it? Let me give a very simple example. I am giving very crude definitions and very crude simple examples out there. Well, who are equity shareholders? Equity providers are the owners of the enterprise. Equity providers are the owners of the enterprise out there. Now, imagine I am a owner of the enterprise. I have contributed, let us say, for example, $100 as equity. You can add any number of zeros. When I contributed $100 as equity capital out there, what is my liability? What is my in the sense, what is my loss, maximum loss? My maximum loss is limited to these $100 out there, because I have provided $100 as equity capital. Company is a separate entity, I am a separate person, I have provided $100 to the company, and the company owes that money back to me, perfectly fine. When they close down, perfectly all right. But and I also operate the company, I sit on the other side and then I operate the company. Now, the company has got $100 as equity. Now, personally, what is my what is my loss? My loss is limited to that $100. Now, imagine I borrow $800 and let us say the total capital is $900 in this case, perfectly alright, then whose risk is high? Risk of the debt provider is very high, because in case the company does not do well, what happens? Who loses? I lose only 100. The fellow who has provided loan to me loses the entire $800 or major part of it out. Or the other way around, moment he has provided $800, I sit on the other side and run the company. What is my first objective? My first objective is to pull out my money. Now there is $900 capital. I will withdraw, or I will take a loan from the company of $100, or I will withdraw $100 from the company. I can do drawings. I explain drawings. I draw $100 back from the company. In the sense, what happens in this particular case? Total capital. Now I will say drawings. If I am a partner or whatever, or if I can withdraw, I need not use it as drawings. I can withdraw in many forms out there. I withdraw $100 from the company. Now what is happening? My investment in the company is zero. So I will have no interest to run the company. The company goes to a loss. The debt holder basically faces a loss out there. This is a very crude reason I explained what it is. I mean, I can sort of explain it in a little more what do you call it, as a professional or a way, but I mean, since again I am looking at the undergraduate level at the first course on finance, I am making it a very crude definition out there. So what is happening? So I need to know how safe. For example, if the same thing, if this fellow had contributed, for example, if the equity fellow instead of contributing $100, if he had contributed $10,000 out there and borrowed 800, then what happens? I know my money will be safe, because that fellow has dug his fingers little more deeper, because he has put in $10,000 equity holder, so he will run the company properly. And my what I have contributed is only $800. So my money is relatively safer in the process out there. So you can argue with me, can there not be a company where debt is higher than equity? Well, there can be situations. I am not completely ruling it out, but normal situation, that is all what we look at. We always look at a equity to be a little more higher than what you call it as compared to the debt portion of it, because there is a cost for everything out there. There is a cost for debt and there is a cost for equity. Now, so as a capital, I will come to the cost part of it a little later. Now, as a capital provider, I am looking at debt and equity out there. So, as a debt provider, what am I looking at? I am looking at the first one, I am looking at what is called as debt equity ratio. I am looking at what is called as debt equity ratio, the percentage of debt and the percentage of equity in the capital structure, so that I know how safe is my debt out there. So what is the inference out here? I want to know what is the percentage of debt in the company. If the debt is only 10% in the capital, then I can provide a little more debt out there. So even after I provide the debt, maximum the debt to equity ratio will be 15% debt and whatever 85% equity. Still my debt is relatively safer in that particular case. So that is what I will look at. Now, is there a benchmark percentage? Well, it varies with the kind of what is called as the industry you are analyzing. I do not want to give a benchmark. Textbook might have some rough benchmarks out there, but personally I do not want to give a benchmark, because it varies with the kind of industry that you are analyzing. If it is an asset intensive industry, asset intensive, for example, I say refinery and so on, your debt could be slightly higher. If you are looking at a service industry, for example, let us say any of the IT firms like Infosys or etc., your debt component is almost zero out there. Equity component is very high, because you are not investing in huge amount of assets per se in that case. So it varies with industry to industry. There is no, is there a standard? Well, yes and no, that is what I would say, and I will leave it there. So when I say equity here and I say debt, debt means higher, I mean all the long term borrowing only. All long term borrowing put together, clubbed together out there. When I say equity, here I mean all money belonging to equity holders. That is equity share capital plus all the retained earnings or reserves and surplus. All the reserves and surplus out there. Reserves and surplus includes retained earnings, the money belonging to the equity shareholders out there in this case. Now, moving further out here, as a debt provider, what am I further interested in? I am interested in how safe is my capital, whether that guy has, the equity provider has a higher investment as compared to the debt. Well, that means he is not going to swindle my money. Relatively, he has more money is stuck out there, so he will be more interested to operate the company. That is what I am going to believe in. Now, the second aspect what the equity holder will be interested in is looking at whether he will get timely interest. Whether he will get timely interest or whether he will get timely what is called as, supposing the principal repayment is in various installments. I borrow 10,000 crores and every year I pay 1,000 crores back timely, that is timely repayment of principal, timely repayment of principal out there, timely repayment of principal, timely repayment of timely interest payment and timely repayment of principal. For this, what do? We do what is called as, we show interest coverage ratio. That is, we say that whether the profit before interest and tax is sufficient, whether the profit before interest and tax, or what we call it as PBIT. This PBIT is how many times the interest out there. This PBIT is how many times the interest. That is, the supposing I would say that is what is called as the profit before interest and tax divided by my interest expenditure. So, what will this tell me? This will tell me the profit as how many times the interest. Higher the number, then the company is in a comfortable position, earning decently well to pay my profit. Sir, profit is not equal to cash. Yes, profit is not equal to cash, but profit has to get converted to cash eventually. That is the belief what we will all work with. Profit has to eventually get converted to cash. So, the profit is sufficient enough for them to service or pay the interest. So, I am looking at whether the interest coverage, the timely payment of interest out there, whether the company is capable of doing this. Sir, why profit before interest and tax? Just hold it for a couple of minutes, I will come back to it. The next one is timely repayment. For example, I said 10,000 crores. 1,000 crores every month, 1,000 crores every year out there. So, what do? The profit before interest and tax again, is it sufficient enough to pay what is called as the interest expenditure plus the principal due? Due in the current term. Current term means in the immediate whatever, that particular period out there. In the current term means current period out there. the principal due instead of current term, let me use the same what do you call it as language, let the current period. In the current term means current period. Supposing 10,000 crores and you are paying 1,000 crores and there is an interest expenditure. So, how many times is the profit compared to my interest expenditure plus whatever is the principal that I have to repay this particular term out there, this particular period out there. So, that will again be a number. So, what happens as a debt provider, if I see all these three things and I feel I am very comfortable, the debt to equity ratio, the debt to equity, debt is very small, equity is very high, very good, fantastic, my debt is safer. The profit before interest and tax is about 15 times, 20 times, 25 times the interest expenditure or 30 times my interest expenditure, very good, my interest I will definitely get it back. The profit before interest and tax is what is called as is about 10 times the interest expenditure plus the principal that is due this term. Well, it is safe. Now, as a debt provider, I look at these three basic aspects and then I will decide whether I can provide additional debt, what is the interest rate I have to charge on the debt, because the interest rate on the debt depends on the risk characteristic. What is the risk characteristic? The safety of your money. If your money is very safe, interest is low. If your money, the safety of your money is low, interest is obviously very, very high. Risk and what do you call it? It's a function of risk out there. If risk is high, your expected return is also very high. Simple. If you invest money in State Bank of India fixed deposit, what is the interest rate you expect? Something around 5.5 or 6, whatever is the ruling rate now. If you invest money in the stock market on inequity, what is the interest rate, what is the return you are expecting? Not the same 5.5 or 6%. It will be far higher. Why? Risk is high. Here assured State Bank of India will definitely give you the money after 1 year. There you don't know which direction the market is taking. So, risk and expected return. So, what happens? Now, if the cushion is very high, then obviously the kind of interest I will demand as a loan provider will also be relatively lower. If the cushion is very, very tight, then the kind of interest I will demand will be very high because I am taking a huge amount of risk out there. So, are our interests not standardized? Well, no, it can always be negotiated. It is always depends on the risk profile. Not I won't use the word negotiated. Based on the risk profile, it is negotiated. That is the term I have to use. Based on the risk profile, the interest rates are negotiated. Now, as a capital provider, what did we talk about out here in this particular case? One second, let me move it. We talked about everything from the debt provider point of view. Now, I am going to talk about from the equity provider point of view. I am using a different color. Now, as an equity provider, what am I interested in? I am certainly interested in, as an equity provider, I will write as an equity provider. I am certainly interested in debt to equity. Why am I interested in debt to equity? Now, please note, why am I interested in debt to equity? Now, let's get to the reason for it as an equity provider. Very simple. I am just going to use a different color at this stage, and then let us say, imagine there are two cases out there. There are two companies, company A and company B. And company A has an equity capital of $100, company B has an equity capital of only $60. Company A has a debt, this is debt. That means borrowing, equity. Company A has a debt of 0, company B has a debt of $40. Total capital is $100. Now the company, let us also take it for the time being, this debt is at 10%. I am taking 10% just for ease of multiplication. You can take any number what you want, ease of multiplication I have taken 10. Now let us look at the company makes a profit before interest and tax. Profit before interest and tax. Profit and before interest and tax of about, let us say, $10. Now what happens? I pay interest. Now why interest out? Please note, debt interest, interest that you pay on the borrowing is always before taxes. Is always before taxes. Interest that you pay on the borrowing is always before taxes. The interest component here is 0. The interest component here is $4. Why? 10% of 40 is $4. Now I will have my profit before tax out there. I is gone, is about $10, is about $6. Again for the ease of multiplication, I will say my tax, I look at Swedish taxes, I say my tax is at 50% out there. I am just taking 50 as a number, you can take any number what you want, any number what you want. Now it is for ease of multiplication 50%, now in tax is $5, my tax is $3 here. So what happens? After taxes, my profit after tax, PAT, or what do you call it, my profit after tax, in this case is $5 and is $3. Beautiful out there. Now what is the return on equity? The return on equity, that is return on equity in case 1 is 5% for both. That is for 60 it is $3, for 100 it is $5. Am I right, Suhail? 5%? Yeah. Now I take the same case out there. Now I take the same case. Imagine I am going to use a different color out here. Imagine it is what they call it as, it's a COVID year, or what do you call it, there is a downturn, it is a COVID year. And because it is a COVID year, your profit before interest and tax, or because whatever, it is a year which is, there is, the economy is down, or whatever it is. The profit before interest and tax drops from $10 to $8 in both the cases. Please note, both the companies are exactly in the same business. Now what happens? My interest is 0, is $4, continues to be $4 because debt I am obligated to pay. This is case 2. Now what happens? Profit before tax is $4 out here and $8. My tax is the same, tax does not change, tax is the same 50%, $4 gone, $2 out here, and then what am I getting? I am getting $4 out here, I am getting $2 out here, profit after tax. My return on equity in this case is 4%. In the other case, for $60 it is $2, for $60 it is, for 60 rupees or $60 it is $2, that is, how much is it? Express it in the form of a percentage. For 60 it is $2 because 60 is my equity out here. Calculate, you guys have to calculate. What is my equity? My equity is $60 and for 60 it is $2. So you'll calculate 3.33%. In the earlier case, what was the return? Return both of them at 5%, fantastic. In case 2, what happens? The profit slightly drops. My return for the equity holder drops substantially, 3.3. I can do one more case. I can do case 3. I will use a different color. Case 3. Supposing the PBIT, the worst COVID year for A and B is $6, drops to $6. My interest component for this is 0, for this is $4. So, 6 and $2. That is my PBT. My tax at same 50%, what happens? $3, $1. So, what happens out here? My profit after tax. So, what is the return on equity? 3%. What is it? $1.60. So, hell, how much is it? 1 by 60.
1 by 60.
For $1 for 60. Calculate the return.
1.66.
1.66% return. So, what do you see in the first case? Both of them made $5, beautiful. But when downturn happens, the debt holder continues to earn the same $4. The debt holder continues to earn the same $4 out there. Even in this case, the debt holder continues to earn the same $4 out there. And even in this case, the debt holder earned $4 there. Debt holder does not take the cut. Debt holder continues to earn the same thing. So, what is the equity holder is bearing all the risk. That is, as the debt increases in the capital structure, what happens? The risk of the equity holder increases because, for example, in this particular case, let us take this case itself. The company says, I need to increase my equity, I need to increase my capital to 120. That's all. The company has said, I need to increase the capital to 120. In the first case, they say, I am increasing what is called as in equity $20. In the second case, I am increasing in debt $20 out there. Moment they increase the $20 out there, what happens? This interest, instead of 4, it will become 6 out here. If it becomes 6, what happens? This will be 4 and this will be $2 only. That is all what happens, and equity holders will get only $2 in this particular case out there. No sir, if they increase more capital, you might say they will get more profit. Agreed. But the day you imagine I have taken borrowed money, I need to buy machinery, I need to invest the machinery, I need to install the machinery, I need to do the trial run, I need to get get a market for that extra investment what I made, etc., etc. And that will all not happen in one day. Whereas the debt has come in as of today. So what happens? Till you reach that extra profit what you are going to get, the profit is going to remain the same because I borrowed to this year, machinery I have ordered, it will come next year, then I will install, and it will, by the time it reaches a steady state, it will take 3 to 4 years. And till that 3 to 4 years, my profit is not going to greatly increase, whereas my debt interest is going to greatly increase because I have borrowed today. So what is happening? Who is bearing the risk? The existing equity holders are bearing the risk out there. So, what do we need? So, therefore, equity holders will also be interested in debt equity ratio. If the debt is going to be high, then their expected return is going to be very, very high, and so on and so forth and etc. So, they will also be interested in what is called as debt equity ratio, percentage of debt and percentage of equity. I hope I have conveyed. Now the next aspect, equity holders, what are they interested in? The further, if I have to say, they will be interested in what is called it as, the next one called as EPS, that is what we call it as earnings per share. What is earnings per share? My profit after tax divide by number of equity shares, or they other name they call it is number of shares outstanding. Number of shares outstanding, that is the other name what they will call it as. This is what I am just going to put it in a, what do you call it as, I mean, you should not get confused if I put it like that, like this. I would say this is either or out there, 1 second, or it is called as, I will just circle it out so that you guys will know very clear about it. So that means what is it? How much how many dollars profit belongs to every share that is there in the company. The company has 10,000 shares. The profit after tax is something. Now, what is the earning each share? Because profit after tax belongs to whom? Belongs to the equity holders. Profit after tax belongs to whom? Belongs only to the equity holders. So, what is the earning each share has made? That is all what we see, and that is what we call it as the EPS, or earnings per share. Now, the next aspect what we talk about as an equity holder, I will also be interested in what is called as the market price. Market price, market price. They are interested in knowing the market price. Market price you will know from the market. You just go to login to nscindia.com or indiasindia.org or BSC India, whatever it is. You will know what is the price per share. And the price per share can keep changing every minute, perfectly alright. You will know that. More interested in what I want to know is what is the price to earning multiple. Because this is what I will use to compare price to earning multiple. I will use it as price to earning multiple, or what they call it as PE ratio or PE multiple. Sorry. What is this price to earning? Market price is X. Now, how many times, what is the market price? That is, market price is a reflection of the performance, earnings of the company. So, what is the, what am I looking at? I am looking at how many times the earnings per share is the market price per share. Supposing I say that I have I've just taken up today's price of Infosys. Today is 19th of January or 18th of January, sorry, 18th of January out there. The closing price of, let us say, Infosys share as of today per share is rupees 1545.40 in fee. I have taken in fee because all of you know about it. I am just using it as an example. I am not advertising for it, I am just using it as an example. We take in fee and 15.45.40. Now I have my EPS of INP, that is info the price per share, the basic EPS I am taking roughly. I am not taking today's EPS, I am taking the rough basic EPS of about, let us say, about 50 or 51 out there, roughly about 51. It is not exactly, it is roughly around 51 basic EPS out. That means what the price is, how many times? The price is how many times? 1545.4 divided by 51, Suhail, what is it?
30.30.
Now that means my price to earning multiple is 30.30. That is 50, what we call it as market price divided by my EPS. So what is it? I have my EPS ready. I have my market price ready. Market. So now I know what is the price earning multiple. I will know how many times I multiply with the price, how many times I multiply with the EPS, I will get the market price. I have a rough range out there. So I will also know, sir, will the PE keep changing every minute? Yes, the PE can keep change every second if you keep on calculating. But I have what is called as a ballpark figure out there. I know the PE is in the range of roughly around 30. I know the EPS is around the range of 51. Fine.